Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, February 28. The Russia-Ukraine conflict is feeding stock market volatility, but history tells us that investors quickly get accustomed to war, and commerce goes on. In Homer's Iliad, father of the Greek gods Zeus says to his son Ares, the god of war, "To me, you are the most hateful of all gods on Olympus. Forever fighting is dear to your heart." Indeed, the history of humankind is a tale of incessant war. During the past 3,400 years, humans have been entirely at peace for a cumulative total of only 268 years. I bring up these facts not to depress you, but put the Russia-Ukraine crisis into perspective. Regrettably, wars continually come and go. It's why global armaments budgets are astronomical. It's also why modern financial markets eventually bounce back from war-induced declines. Take a look at this table. I realize that current geopolitical turmoil poses challenges to the global economic recovery, but as I'll explain, I'm also confident that underlying fundamentals remain strong enough to prevent the market's weakness to lapse into a prolonged bear market. Instead of advising a risk-off strategy right now, I actually see the war-induced market slump as rife with buying opportunities. Notably, several technology names that were trading at nosebleed levels are, because of the Nasdaq's correction, reasonably valued again. Certain investment megatrends, such as the increasing prevalence of the Internet of Things, are unstoppable. The following chart depicts S&P 500 drawdowns over the past 5 years, along with the catalysts for the market corrections. Take a look. History shows us that the stock market regains its footing after the initial shock of a geopolitical crisis wears off, particularly when, as is the case now, the economy and corporate earnings are on solid ground. Russian President Vladimir Putin last week launched an invasion of eastern Ukraine, precipitating the worst outbreak of military hostilities in that region since World War II. The death and destruction, as well as Putin's belligerent rhetoric, sparked volatility and big declines in European stocks. By the end of the week, U.S. stocks held their own in choppy trading, but the main international and European indices ended the week in negative territory. See the following table. Keeping markets aloft was the calm but resolute response of Western leaders. The United States and European Union immediately imposed tough sanctions targeting Russia's major financial institutions and curbing tech exports. Sanctions refrained from banning Russia from the crucial SWIFT payment system by which global payments are made and embargoing oil and gas purchases from Russia. The West is trying to thread the needle. It wants to punish Russia, but not at the expense of their economies. Keep in mind, the volume of trade between the U.S. and Russia is minor, and Russia's economy is only the 11th largest, accounting for less than 2% of global gross domestic product. That said, Russia is a significant commodities producer and exporter. Nearly 40% of Europe's natural gas and 25% of its oil comes from Russia. Russia also is a major exporter of wheat, accounting for about 25% of the global wheat market. Along with energy, agricultural and food costs have been skyrocketing. It appears that the major adverse consequences of the Russia-Ukraine conflict is the prospect of inflation that rises worse and lasts longer than expected. The U.S. Commerce Department reported last Friday that the Personal Consumption Expenditures PCE index in January shot to a new 40-year high, driven by surging food and energy prices. The PCE rose 6.1% over the past year, the fastest pace of increase since 1982. Prices climbed 0.6% in January from December, up from 0.4% the previous month. When geopolitical crisis hits, oil prices typically shoot higher. This time around was no different. Take a look at this chart. U.S. benchmark West Texas Intermediate and international benchmark Brent North Sea crude shot past $100 per barrel for the first time since 2014, before settling into the 90s. If the West reaches a nuclear deal with Iran and sanctions get lifted against that major energy producer, crude oil prices could ease in coming weeks. What's more, the U.S. is coordinating with allies the release of strategic reserves, and U.S. shale producers seem eager to boost production to profit from high prices. There's another positive factor at work. The Russia-Ukraine war could prompt the Federal Reserve to ease up on tightening to shore up the vulnerable economic recovery. Under the conditions that I've just described, energy-linked equities and exchange-traded funds make sense now. Rising energy prices raise corporate costs, hurt consumers, and generate greater pain at the gasoline pump, but they also lift the earnings and revenue of the oil and gas sector. For a compelling energy play now, consult the article that accompanies this video on the Investing Daily website. Well, that does it for today. Thanks for watching. Stay invested and, despite reports of war overseas, please stay calm.